in the market historically, let's say go back to 1965 or whatever, the market's return on average 8 to 9%, right? But this research project found that most people, they only earn 5%. So like there's this gap, right? So if you just invested in an index fund and just follow the market, you'd earn 9%. But people do all these weird things, right? And really they're earning below the average, right? The average returns, meaning that 50% of people are earning higher than that, 50% are earning lower. But what do you think contributes to that? Why do people, realize returns that are less than average when there's so many resources out there and so many strategies they could follow?
Yeah, well, I think the first thing is the fees. The vast majority of investors are holding, something instead of holding a portfolio of ETFs, of low-cost index ETFs, where their all-in fee cost is something like 5 basis points a year. Mm-hmm. They're holding extremely expensive, mutual funds that charge, hundreds of basis points of fees. I mean, not to mention the fact that their advisor is also charging 100 basis points in fees usually on top of it. And so the fees, that's why part of the way that you can figure out whether your advisor is doing the right thing for you or the wrong thing for you is you just look at the fees. If the fees are high, then what's happening is they're getting paid and you're paying for it. Right, in your returns. That's all there is to it. And so fees. Focus on your fees. Focus on bringing your fees down. And then the second issue is the market timing issue, which is that instead of dollar cost averaging into these assets over time, people are trying to time the market. And when you're trying to time the market, I mean, literally, there's an entire hedge fund industry built upon taking money from individual investors who poorly time the market. So every time you're going there and thinking, hey, look, I want to trade, or I don't, I want to trade today, or I want to shift between cash and assets, or I want to sell my stocks and buy this, or buy this individual stock or sell this individual stock, recognize that there is an entire industry that makes $700 billion a year built on the back of people making that set of decisions poorly. And so the way to avoid essentially that cost, right, that index drag is what you're talking about, is simply to calmly and uniformly buy the market every month, put a little bit of money away, buy a diversified portfolio of assets. And frankly, if you do that, the best portfolio that you can have is one you don't even think about, right? You don't even worry about. There's lots of things to worry about: your job, about, your family, about your health. There's so many things in this world to worry about. There's no reason why you should worry about your investment portfolio, right? And that's the basic idea: is create yourself a long-term game plan that you can stick to and that won't cause you, that's low cost, well diversified, and, something that you can stick to through time, right? Where you're not trading all the time, and you'll be good. You'll be good in 30 years. It'll be a good outcome for you.